Hello, hello, hello. This is Chris Vogt, the Secretary Treasurer 2026, Secretary Treasurer of the Realtors Commercial Alliance of California. Last year, I was the president and very excited for the new year. This is going to be fantastic. And today we're having our first live stream of 2026. We got some good stuff coming up. You're not going to want to miss it. So today our guest is Roman Basi, or is it Basi? Roman, and I met him at the International Business Brokers Association conference in Denver, Colorado. What was that, about 3 years ago, Roman?
Yeah, probably. And it is Basie, like Count Basie. So,
Yeah. Okay. Good. It was like, oh no,
nope, all good.
got to get the pronunciation right. And Roman and his dad, they were both speaking at this conference, and both of them were excellent speakers, and they presented information, some of which I was not aware of. And so it's always exciting when you go to a conference, you learn new stuff. And I got a preview of the PowerPoint that Roman's going to be working off today, and he's going to be talking about some cutting edge stuff. You are in for a super treat today. But before we do that, I want to quickly um, show you, where's my screens? There it is. I want to introduce you to the Realtors Commercial Alliance, because the Realtors Commercial Alliance is the only association of realtors in California, the entire state of California, that is exclusively focused on commercial real estate. So we're very excited about that. In our mission statement, as the only commercial association of realtors in California, we empower members to thrive in commercial real estate through education, networking, and fostering collaboration among commercial, residential real estate professionals and business brokers. This year, our team, we've got Helen as our president. I'm your secretary treasurer, and I'm the CEO. Matt Cortez is our director at large. Steve Haddadin is our general counsel, and I also serve as the association executive. So why would you want to join us? And membership it's very affordable. It's like less than a cup of coffee and a muffin at Starbucks every month. That's how much it is. It's very, very affordable. And so we offer commercial real estate education and training. Once a month, we do a commercial real estate project pitch and professional networking on Zoom, where you can share your commercial real estate haves and wants and connect with your peers. We are looking at doing some social events this year, and we have a member hotline. And here's the member hotline. It's actually a voice over Google voice number. So don't call it. No one will answer. You'll get voicemail, but we do prefer you text, because the text messages are forwarded to our email, 949-371-6611. If you want to give us a call. And we do invite you to check out our website. We're in the process of redoing our website. And if you go to the website, there is a sign up form there where you can join our email list and be kept in the know for what we have going on. And coming up today, you can see we're doing our commercial real estate tax optimization for commercial real estate brokers, commercial real estate owners, and investors. And then coming up on the 21st, in a couple of weeks, we're going to be doing our commercial real estate property picks and professional networking Zoom. So, but today's the day. We're doing commercial real estate tax planning and filing. So we're going to be talking about tax changes that are applicable to commercial real estate brokers, investors, and owners. We're also going to talk a little bit about some business brokerage stuff, tax options for minimizing and deferring taxes, and how to strategize to take advantage of all available tax credits, deductions, and structuring mechanisms. So, and we are live with that right now. So welcome to the program. And Roman and I had a chance to chat just for a few minutes before this. We both have a love for aviation. We have relatives who are pilots, actually two of the youngest female pilots in the entire world working in commercial aviation. So Roman, welcome to the Realtors Commercial Alliance, our first live stream of the year. Glad to have you.
Thanks, Chris. It's great to be here.
Excellent. And so, Roman, tell us a little bit about yourself. I mean, I would rather let you toot your own horn than me just reading a little bit of a script, how we always get the bios from people. But what's most important in your life?
Oh, my family. No doubt about it. I mean, my family is number one in my life. My wife, my girls are the top of my list. So there, that is it. So
That's great. And so, actually, Roman's daughter, is it your older daughter or your younger daughter that's the pilot?
our older daughter's a 25-year-old. She's a pilot out of St. Pete or out of Miami, but she lives in St. Pete, Florida, here close to us here. And I live on Clearwater Beach here. So, yep.
Okay. And your other daughter has one of the most important occupations on planet Earth, and that's educating our youth.
Yes, our daughter Lexi's a 22-year-old third grade teacher in Nashville, Tennessee, which we're so thankful for. And that's also close to our Illinois corporate offices and our home. So one of the things we just mentioned the other day, we get to see our girls all the time. Our friends probably say, Roman, you're always seeing your girls, but we're so thankful that we are always around our girls. It is our whole life. I've been married to my wife for 27 and a half years, the most beautiful thing in the world. And yeah, that was an easy question. I could talk about them all day.
Well, both of my daughters moved to Nashville.
Awesome.
Um, one is a NICU nurse, and the other one is actually part of your profession. She is a professional tax practitioner.
Oh, I like it. Good.
Yeah,
Yeah.
yeah.
Lots of
So, um, tell us just a little bit about your background. How did you get started in tax and real estate?
When I came out of college, I played baseball in college, and I came out of college with a biology degree, and I really didn't know what to do. So I went back home, and my father had a real estate operation. My father is an attorney, CPA, has a PhD in economics, and I joined my father in 1997. Started to learn a little bit about our businesses, and we already had some real estate. We had about 70 properties at that time. In 1997, he had been investing in the Southern Illinois markets. So I joined him. I went on, and he just said, "Get your MBA, and you can run the real estate company." So I got my master's in business administration. I then followed that up with my first realtor's license back in 2003 while I was in law school. Finished law school, got my realtor's license in 2003. At that point, the firm had my father had retired. He was a retired professor from Penn State, where I was born, and Southern Illinois University, the Salukis. If you've ever seen the NCAA basketball tournament, they make it every once in a while. Southern Illinois school. And so he started one of the accounting programs there, one of their master's programs. So I did my accounting, and then I started my accounting classes there. Our firms, we have an accounting firm and we have a law firm now. We kind of started to, as I was growing those firms, we started to get into consulting to businesses, doing a lot of mergers and acquisitions. Of course, that comes into a lot of commercial real estate. And I work with business brokers all day, every day. And so that's just morphed into now my real estate investment company. We have 294 properties. We're going to be adding 11 here this year already in 2026. I own all of those. Our company in Illinois manages those. I've been a real estate broker since 2003. I'm the two-time past president of what was called the Egyptian Board of Realtors in Southern Illinois. I think we just have, I'm a member, but no longer really active with them. And I think they just merged. When I was the president, I believe we were the largest geographical board in the country. And that's really because of the rural nature of Southern Illinois. And I think I was the youngest president they ever had at that time, but I was a two-time past president. So real estate has been a huge part of my life, as has mergers and acquisitions of privately held companies. As I was telling you, Chris, earlier, I do a lot of lower middle market. I am Main Street, but I do a lot of lower middle market, and I do work all over the country. I'm a federal tax attorney. That's what we come in on. So whenever we're called upon in these transactions to minimize tax liabilities, maximize their legal protections, and with that specialty, we've got a niche, and I love it. I absolutely love it. This is my favorite thing. Honestly, speaking and educating people is my favorite thing. If I could do it all day long, I would. But the next favorite thing in the work is just the M&A work. It is a person builds a business, and they're going to do this one time in their life, maybe. Some people will sell a business, they'll go through a couple businesses, but most business owners, they're going to do this once, and it's their retirement, it's their entire life. And I really take that to heart. I really do. When we get involved in a deal, I tell my clients, I'm like, I'm 24/7 to you at that point. Especially now, my girls are older, and my team is phenomenal, and they're all based in our Illinois offices. And that's really why, that's my background. That's what got me here. That's what continues to drive me in these transactions and to continue to learn. Chris, you just taught me a new term. I mean, I learn something every day in every deal. I tell everybody I talk to that. So, and that was people ask me, "Oh, what was your key in life?" I'm like, I don't stop learning. I'm always in school. I'm doing a valuation certification class right now with the AICPA. So I never stopped learning. So that's what got me here. And I really like what I do. And I'm so glad to be presenting to all of you guys today. I really appreciate it.
Excellent. Well, we appreciate you being here. And why don't you go up and pull up your presentation? And while you're doing that, I also graduate from college, have a Bachelor of Science in Biological Sciences with a pre-med emphasis, but I never went to med school. So another point of commonality.
Yeah, I'm glad it didn't work. When I came out of school, they wanted me to, there was a radio job that got offered to me, as I was telling you earlier, and I didn't want to do that. But as we talked about earlier, it really worked out for me. I did I had a biology degree, but I did a 180, and this was my calling, that's for sure.
Excellent. So as people who've subscribed to the channel know, I have a background in talk radio, and so I like to interact a little bit. And so Roman is prepared. So if I pop in with a question or not, he won't be taken too much aback, right?
I hope so. Sometimes on a tax programs, I'll have my staff listening in on sometimes. I don't have them listening in right now, but if I need them, they will. And they support me like crazy. Yeah, they can answer questions for me and do a lot of that. But that no problem. And if I don't know an answer to something, you're gonna get an email back with it. You're gonna get that answer back. That's just one thing. We want to make sure that everybody's questions are answered, and if we can guide you right, we'll guide you right. So
Yeah. So if you do have questions, feel free to put them in the YouTube comments, and I will pass those on to Roman if we have any as we go, finding the appropriate time to break into the presentation. So if you see my camera go off and on, it's because I've got another computer here and I don't want to distract people as I'm looking at the other computer. All right, Roman, I am excited to hear your presentation. And because we're streaming on YouTube and people can watch the replay, if we go over time, I'm not worried about that. So take all the time you need to thoroughly educate us today.
yeah, Chris, and what is the end time you guys usually stop at? Just so I know if I go way too long, I don't want to go way too long.
Oh, the
30
12:30
minutes, yeah,
Pacific. Yeah, so we got like 45 minutes.
no problem. And I'm on Eastern time today, talking to y'all. So okay, sounds good. You want me to start?
Let's do it.
Right. It's been a great year already. I mean, 2026 has absolutely come in with a bang. We got very, very busy. I always kind of judge what's going on in the tax world with what's happening in our M&A transactions, and all of a sudden we're getting very, very busy. We didn't have a lot of closings before the end of the year as we usually do, but all of a sudden we've got some in January. I'm working on a $9 million transaction right now in the electrical conductor industry. So we've got a new tax law, right? So we've got the impact of these new and existing tax laws on commercial real estate and business brokers. So really, really happy to talk to you. I've spoke to some broker groups in the past, and sometimes the broker groups are so centered on residential real estate, but we know as coming into this field with commercial real estate, selling businesses, there's a lot more that we interact with from the tax side of things when we're looking at this. So we're going to go through these new tax laws. Some of them you may know, some of them you may not know. There's a couple new things in here that I want you to know. So as Chris said, here's my bio. I am an attorney. I have a state license in Illinois, Florida, Missouri, and Arizona. Took 4 different bar exams, or got reciprocity in one of those states. And that just allows me to go into court in those states if I need to for M&A work, or sometimes I'm more of a trial expert when I have to go in and be an expert witness on a valuation of a company. So sometimes we'll get a law license. I'll try to attach a law license when I need to. But I am a federal tax attorney. I work all over the country and really focusing on minimizing a tax liability for a business owner. Again, they're going to sell this business once in their life. Why do we want to pay off so much to the government? And I tell my clients, and I'm here to educate you today. I'm not here to sell my services at all, but I do tell my clients this. I say, whoever you use, they should act as an insurance policy for you. I won't do anything that's illegal, but I do work in the gray area of the tax code. And when I say that, here's what I mean. The tax code has treasury regulations, and then treasury regulations have private letter rulings, and then private letter rulings, we have tax court cases. So when I'm looking at a tax code and I'm wanting to know, does my client's situation fit this code section? Some accountants will look at it and say, nope, the code says no, but they're not looking at the treasury regs, the tax court cases, and the private letter rulings. So I always tell my clients, I'm going to be your insurance policy. I'm not going to give you advice that I cannot defend in an audit. And boy, does that just gives them that confidence that they can go forward. All of the advisors, you as well, should hopefully be acting in that same way, or they should find someone that does. I am a CPA. I'm a managing real estate broker in Illinois. We have that managing title. I'm also a real estate broker in Florida as well. I'm a title insurance agent, a president of, as I said earlier, we have a separate law firm and a separate accounting firm, and I'm the president and managing partner of both. There's my email. If you guys have any questions today at all, you're welcome to shoot us an email. One of my staff will probably answer the email right away for you. Again, we always learn something, so we welcome your questions. A lot of those types of questions get put into our future presentations as well. Also, any feedback you've got for me, I'm always looking for constructive feedback. So you got any feedback on the program, let me know. And I'm just going to take a quick glance here. I'm going to have one of my staff members join. So if I have any questions, I can hopefully answer them quickly. So what are today's objectives? Let's explore the tax implications of the new tax bill on individuals and businesses. So they asked us today to speak a little bit about individual taxes as well. And I like that because yes, we all have our businesses that we're running or being a part of. We may have our own real estate investments that we're doing. Like I said, I think I told earlier to Chris, or what I might have said in the introduction, you have a real estate investment company that has 294 units. We will be at 305 sometime this year. So even if you're here just listening in for your own investment purposes, hopefully there's some things here that you can take away from it. Explore the tax implications of the new tax bill on both individuals and businesses. Understand what options are out there to minimize and or defer taxation. And let me digress a second. I had one of my college roommates email me this week, and he had a stock option on a business that he was a part of, and they were paying out the stock option. And when they did that, watch this, even though it's not necessarily the M&A field or commercial real estate, but watch this, because you're going to know what I'm going to talk about. Part of his payment was ordinary income. They gave him like a $30,000 payroll check. And then part of his payment was for his stock options. And that was treated as capital gain. And they wired him that money because it didn't go through their payroll accounts. Because it's capital gain, now we can talk about deferring taxation on that payment. One of the best ways that we have, which relates to us as commercial real estate brokers, as all of you probably know, is what? Qualified opportunity zone funds. So he can take that. I told him, I said, Russ, even though he's not in our fields, he's a software engineer, so he knows nothing about this stuff. I said, Russ, we can take that. Usually those units are sold, and you guys may correct me on this, but I find that the units are sold in minimums of $100,000 of investment. So I told him, I said, Russ, you can take that $100,000, put it into a qualified opportunity zone fund. It gets recognized as gain. You know what he can even do now? He can put it in the fund now, and it's not recognized as gain right now, which means he wouldn't have to pay an estimated quarterly tax on it if he doesn't want to. It's recognized on 12/31 of 2026. The law got renewed. I think we have a slide on it maybe later. The law got renewed. So if you put the gain in 2027, it's going to get deferred longer. But right now, the law expires at the end of the old law expires at the end of 2026. So you can't defer the gain recognition any farther. But then what happens? If the money is left in that account for up to 10 years, the growth is tax-free no matter what it grows to, and you can keep it in there longer than 10 years. Let's just say it doubles. And now your $100,000 investment is $200,000 and you pay no tax. It's like a Roth IRA, right? It's structured just like that. There were better benefits to the law when it first came out, but as those expired, and now we have a new law for qualified opportunity zone funds that starts 1/1/2027. By the way, I can't see your chat box in YouTube, but Ian is watching. So if you put things in YouTube, he'll make an answer to you, and I'll review them with him later. I don't have that on my screens. So just so everybody knows. Let's learn how the new tax bill has affected the real estate and the M&A landscape. I mean, we're expecting really good things, right? I think that's why we're already seeing this ramp up in activity. Interest rates are coming down. The Fed's reducing them. The next meeting is at the end of January. Inflation has come down a little bit. I know there's other things. One thing my father always taught me, I don't talk politics as a tax attorney, because he and I are tax attorneys. He said, Roman, he goes, you always want a new president, whatever your side of the fence is. He goes, Roman, you always want a new president in the White House every 4 years because they're going to change the tax bill and we will always have a job. And boy, was he right. I mean, my career now, this will be 28 years in May. right? 29 years in May. Yeah, 29 years in May, I'll have been working, doing this field. I've seen so many new tax bills. So very important. And then we strategize throughout the years to best align yourself to take advantage of all available tax credits, deductions, and structuring mechanisms. Again, something I do. I do what's called a written strategic plan for businesses. This is not some conceptual plan. I will go into a business, and you can do this too, and I will make an entire written set of recommendations for them on how to take advantage of all the available credits, deductions, what type of company are they, how are they owned, what's their estate plan look like. I give them a written strategic plan step by step, and I tell them what each part has to have done. And then I can do it, or they can do it, or they can have their own professionals do it. It's called a strategic plan for the businesses that we represent. So it's a very, very good tool for them. Okay, let's talk about the tax rates and what was made permanent. So the Tax Cuts and Jobs Act, now that was back in 2017, established 7 ordinary income tax brackets for individual taxpayers between 10% and what we know that, the 37% high rate. Again, we know that your state tax in California is one of the highest in the country, if not the highest, I believe. So then you've got to add your individual tax on top of that. These brackets were scheduled to expire at the end of 2025, but the One Big Beautiful Act made the TCJ8 rates permanent. We always hear these words permanent with tax laws. They're only permanent until we get a new, until the Congress flips over and we get a new president. Then the new president's going to make something else permanent. So really, they use these words because they want to try to make everybody think, oh, you have this for the rest of your life. And that's really not true in the tax world. So be careful. There's annual inflation adjustments to the rate brackets thresholds. Let me digress on another example because of this. I had a client in California. He was getting ready to sell his company. And I mean, maybe within like 6 months or a year, he was getting ready to sell the company. I think he had an offer on the table or a couple of offers on the table. And he calls me and he says, Roman, it's going to be a stock sale because of the way that we transact business. And as business brokers, I think a lot of you know you can sell assets of a company or you can sell their stock. And in this case, it was going to be a stock sale. He goes, but Roman, he goes, I want to move. He goes, I'm contemplating moving to Florida. And could I sell the stock of my company in Florida and thus pay a lesser income tax rate when I do? And sure enough, so what we did, and we talk about structuring what we do. So we sold the business in California. We sold some of, we didn't do an asset sale. We did a stock sale of his stock, but we reported some of the sale of California, the part of the business that was related to California. And then we reported the sale of his stock because he became a Florida resident to Florida. So sometimes moving states will create a tax benefit for us prior to selling a business. Some of you may have heard of Puerto Rico. What is it? Act 60, I think is what it is, where we move a business's operations to Puerto Rico. We headquarter them there. They have a low income tax rate and a very low capital gain rate when we sell the business. There has been additional changes to the current favorable treatment of the long-term capital gains and qualified dividends because they continue to be taxed at a range going from 0% to 20%. In a lot of our cases, a lot of our taxpayers will be maybe 15 in the fifth. There's a 0% bracket, 15% bracket, and 20. And the 15% bracket is if you're like under $619,000 married filing jointly or something like that is the rate. And certain long-term capital gains attributable to real estate depreciation deductions are still taxed. Now, remember what I just said. Certain real estate depreciation gains become what we call depreciation recapture tax. When a piece of real estate is sold, and let's say you had a piece of real estate on the books for $1 million, and the client has depreciated it down to $500,000, and now they're going to sell the piece of real estate for $2 million, and you want to know what's the tax impact. So what happens is the first $500,000 is still their basis, and it's tax-free. The next $500,000 is what I'm talking about. The IRS comes in and says, we gave you the benefit of depreciation. Now it's time for us to recapture that benefit. And you're taxed on that at 25%. And then the rest of the gain, $1 million to $2 million, now becomes regular capital gain. Did you hold it short term and it would be an ordinary income tax rate? Or did you hold it long term and it'd be the nice, favorable long-term rates? So those of you that may be new to the industry listening or are curious about how taxes work in a commercial real estate deal, you gotta watch out for depreciation recapture. It doesn't just impact us on real estate, right? It impacts us on what other things? Equipment, other things we have depreciated. So sometimes an accountant will say, well, you want to take a 179 deduction right away, buy a piece of equipment and deduct it, or take bonus depreciation and deduct it. But you may not want to do that if you're going to sell the company in the reasonable near future and you don't need that deduction for that tax year. Don't take it. You're going to have more tax-free basis down the road. One of the MOs of being a tax attorney is what can we do to defer taxation? What can I do so that the present value of my dollar is stronger? If I'm not giving my dollar to the federal government and I can defer it for a year, 2 years, or 3 years, and I can make a return on that dollar because the IRS isn't going to give us a return. That's what a tax attorney wants to do. We want to defer or exclude taxation from these deals. So we watch out for that in real estate when we're looking at that depreciation recapture tax rate of 25%. What can we do to carve around that in some transactions?
So before you keep going, you brought up something interesting, and that is recognizing income in different states. And one question that I've not gotten a good answer for yet is if you're doing a 1031 exchange, I know like California, if you do a 1031 exchange and then you move to another state, they're going to follow you until you die to see if you go ahead and sell that asset you exchanged into. And can you pay the tax in California so they don't follow you for the rest of your life?
You so you're trying to say pay the deferred amount of tax on the gain that you're deferring to the state? Is that what you're asking
So
for?
instead of deferring it for your state taxes, where you're deferring it for federal, can you recognize the gain for California and not and do a 1031 exchange for the feds?
I don't see why you couldn't. I mean, you're making the election to defer the gain. The problem would be is, yeah, that's a great question. Ian is listening in. I'll have him look. That's a great question. Could you defer one and not the other? Or would the recognition of the California gain cause what I call a red flag audit with the IRS because your two returns wouldn't match up. You'd be
Yeah.
showing two different gains. So that's the only thing I would be, and Ian may even have to ask one of our senior CPAs, does that cause an audit when the capital gain? That's really the question is, does the capital gain on the state tax return have to be the same as the capital gain on the federal return, or will you be audited? So that's what I would look for. And we'll get you that answer. That's a great question.
Oh, thanks. Appreciate it. All right. And back to your show.
Okay, so the TCJA dramatically increased the standard deduction amounts when implemented. So the basic standard deductions now are as follows. As a single or married filing single, it's $16,100. These are your basic standard deductions. Married filing jointly is $32,200. Head of household is 24,150. 2,000 for an unmarried individual age 65 or older or blind, and 1,600 for a married filing joint individual. This brings up something I see all the time on TV. So a single person's or YouTube or TikTok, whatever you all listen to, but the single person's deduction is $16,100. So you'll see this thing on the news about you can pay your kids, you can hire your kids and pay your kids, and you can pay them tax free. It's true, but here's how it has to be done. You have to have a company that is not incorporated, that you can then pay your kids from this non-incorporated company. So it has to be like a sole proprietorship, filing a Schedule C. And you can pay your children up to $16,100. You can deduct that payment in the company. It is not income to the children because it's their standard deduction. And you're able, then you can take that money and put it away somewhere. And a lot of us will put it away into like a college fund. That's the trick. You have to have, now here's how do you do it? You're like, well, we have a sole proprietorship where we're going to manage our other companies. So the sole proprietorship is managing the other companies because you want to be incorporated for legal liability purposes, right? This is where you can pay your kids at. So you pay management fees up to the sole proprietorship. You can pay your children out of the sole proprietorship, take the deduction. It's not income to them. And you've got $16,100 for every child that you can then sock away into some type of investment fund if the child doesn't want to take the money themselves. The real key there too is the child has to be of a reasonable age to be able to work. You have to watch out for child labor laws. and they've got to be doing a job that they could legitimately do. I was the highest paid grass cutter in Southern Illinois for probably 15 years. So that's how my dad works those angles. My brother was the highest paid lifeguard in Southern Illinois for a while. So these are how, and that is so it's a valid, you'll hear this a lot on TikTok and YouTube and these things. Again, it's valid. How do you really make it work? That's how you make it work. The Big Beautiful Act also makes the enhanced standard deductions permanent, and they increase in 2025. The increased standard deduction amounts will be adjusted for inflation for 2026 and beyond. And as before, additional standard amounts are allowed for individuals who are 65 or older or blind. So it's the SALT limitation, the state and local tax limitation. As we all know, this was pretty dramatic for a lot of us for the last couple of years because the TCJA limited our deduction to $10,000 or $5,000 married filing jointly. So state and local taxes, meaning your real estate taxes, and what the limit on the limitation was. Do not get this confused. In Illinois, this law comes out. There's a business owner on the news being interviewed by our local ABC station who owned rental real estate, and he's on there complaining that he can only deduct $10,000 now of his real estate taxes on his rental real estate because of the SALT limitation. And of course, that's not true. For businesses, commercial rentals, residential rentals, whatever you pay in real estate taxes is fully 100% deductible. This is a SALT limitation on a personal tax return on your 1040. I happen to have a home here in Florida, and I'm so thankful that the new bill, as you see in the second bullet point, increased the deduction limit to $40,000 for married filing jointly with 1% annual inflation adjustments subject to income-based phase-outs. For 2026, the cap will be $40,400. So it does cap itself out. Now, the QBI deduction, as many of you may know about this, and this has a big impact on how we operate our businesses, qualified business income deduction. Again, the OBBA made this permanent for their QBI. What does it mean? The deduction is up to 20%. You got to be what's called a qualified business. So you got to look up that terminology, say, am I a qualified business to take this deduction? You've got to be a flow-through entity. So what do I mean by flow-through? So you can have different types of businesses. You have a sole proprietorship, which is a non-incorporated business. You're going to file a Schedule C on your tax return, and you'll be able to get, so if you make $100 in profit or income, you can deduct 20% of it and not pay taxes. This was a really big benefit of the new bill. We didn't know if this was going to stay in there. So this helps S-Corps, LLCs, and don't tell me, whenever I ask somebody what type of corporation they have, and they tell me LLC, now, I'm a federal tax attorney. The words LLC don't mean anything to me as a federal tax attorney. You still have to pick up your method of taxation. An LLC is recognized at the state level, but for tax purposes, are you a sole proprietorship, meaning a disregarded entity? Are you a flow-through entity called an S-Corp? Are you a C-Corp? Why would you want to be a C-Corp? Because the flat tax rate on profits is 21%, and that's stated in the bill. And you may look at me and say, Roman, I don't want to be a C corporation because I heard of double taxation. What does that mean? Well, if you leave profits in the company, you're going to pay tax at 21%. And then if you want to take those profits out as a dividend, you're going to pay a dividend tax, and the dividend is not deductible. Double taxation. But what privately held company in the United States, and again, I work with family held companies across the US and again, lower middle market, what small company like that or family owned is paying themselves a dividend? So in my case, I have to compare is the QBI deduction, because you don't get the QBI deduction on a C corporation. So I have to compare is the 20% QBI deduction, and I'd be a sole proprietorship, S Corp, LLC taxed as an S Corp, a partnership filing a 1065. Is the QBI deduction worth that? Or can I be a C Corp, pay a 21% flat? I'm not going to have profits. Don't even worry about the 21%. Most of us are going to take those profits out as what? Salary, bonuses. We're not going to keep our profits in the company usually. And so a C corporation has a 0% tax rate if you're running it right, and it flows down to your personal tax return. And if you leave a profit in there, it's 21%. So then I've got to compare, is the 20% QBI deduction worth it? Or would I rather say, you know what? When I do it, I'm not going to have a profit, but if I do, I'm going to pay a 21% flat rate instead of this 80% left over in an S corp that would get taxed as high as 37% and then add California's taxes onto that. So in 2017, when all of this came out, when the flat rate for the C corps came out, we started to convert companies from S corps to C corps, from LLCs to C corps. And now there's another huge benefit to a C corp. All of this gets talked about with this QBI deduction. If I look at a C corp and you're a qualified business, what I'm going to talk about might have a slightly different definition, but don't get too wrapped up in that. It's called qualified small business stock, section 1202 of the Internal Revenue Code. And what qualified small business stock is C corporation stock that was initially issued to you. You held it for at least 3 years. There's a new law now. You've held it for at least 3 years, 4 years, 5 years, or more, and you can sell that company completely tax-free up to $15 million of gain per shareholder. So when I look at a business and decisions that we're making, strategic planning, right? I'm looking at what type of entity are they? Are they taking advantage of a QBI deduction? Are they getting the QBI deduction? This will show up on their K1 statement, their flow through statement. What about a C Corp? Do I want to convert them to a C Corp? Are they going to sell in 3, 4, or 5 years? Can I sell the stock and not the assets? You got to sell their stock. Can I make them into a C Corporation? And I've done this, and I've done this in California. And we're still working with a client right now. We took his pest control company about 2 or 3 years ago. It was an S Corp. You can't convert under the law. So what you do is you form a new C Corp. You transfer all the assets in an Internal Revenue Code section 351 transfer, so it's tax-free, same ownership. You've got a new C Corp going forward. You can even retain the name. You usually can't keep the FEIN number, but I'm hearing that you can somehow. So I'll have to talk to my people about that. But you have this new C Corp going forward, and he's about 3 years in. So now he's under the new law pretty soon, but he's going to wait at least 5 years, and then we're going to sell the stock of his company tax-free up to $15 million per shareholder. So the QBI deduction is great. Don't give C Corp such a bad rap, though, because of all those issues you got to think about. Starting in 2026, the taxable income phase out threshold that can reduce or eliminate the QBI deductions increases. So it increases to $75,000 for single people or $150,000 for married couples filing jointly. And that's really good too, because I do see a lot of my clients that they have the profits in the business and they phase out of the QBI deduction. Then why are they an S Corp anyway? What benefit are they getting? Again, if they're going to take the profits out of the company, why not just be a C corporation? Why not? Now, if you leave profits, I don't want to get too deep, guys, but if you leave profits in a C Corp, it's okay to do it. But if you do not have a plan for their investment, because the IRS says you're running a C Corp like a big Walmart corporation. So the IRS says, look, if you're going to leave your profits in there and not pay dividends to your shareholders, you're going to pay an additional tax called the accumulated earnings tax. But if you have a plan for their investment, then you don't have to worry. You can leave the profits in there, pay 21% flat tax, and then say, yeah, we're going to buy a new building. We're going to add a warehouse. We're going to add an equipment line. We're going to buy more inventory. Have a plan. Have it in your corporate record books. Now, that's a whole subject for another day, is corporate record books. But have a plan in writing if you're going to leave profits in a C corporation. So now let's move on. This was a big one. We didn't know what was, when I do a strategic plan for a business, or a company, or a family, it's a full circle. I want to complete the circle. And what do I complete it with? Estate planning. So the Tax Cuts and Jobs Act significantly expanded the unified federal gift and estate tax exemption. We didn't know where this was going to go. And again, now it's permanent. But for 2026, the exemption has now increased to $15 million per person. So you could pass away at the federal level. And if you have 15 million of assets in your name, you will not pay tax at the federal level on those assets. And 30 million if you are married. And it is adjusted annually for inflation. We really needed this because our tax law was set to expire. This would have dropped down to 5 million adjusted for inflation. Anything else you would have been taxed on. I'll give you two examples. So, and you got to be careful with this. Wherever, whatever you're doing. We had a client come to us, and again, this estate planning is a huge part of it. We had a client come to us in Illinois, one of the largest truck towing companies. They tow like semis when there's accidents on the highways. One of the largest truck towing companies in Illinois. And the father passed away. And the son came to us and said, I'm being told that I got to pay tax, but my dad had all of this in a trust. Be careful. There's a lot of advisors out there, let's use that word, and they love to use the word trusts and all these fancy trusts, California Gold Mine Trust and Alaska Dynasty Trust. Folks, there's two types of trusts. That's all you need to know: revocable or irrevocable. Irrevocable, meaning one you can revoke and change at any time, and one you really can't change. Although, like I told you, I'm a lawyer. I work in the gray area. You can change an irrevocable trust. Don't let that fool you. So the client comes in. I said, let me look at these papers from your dad. He's like, well, dad put everything into a trust and said he was taking care for tax purposes. The very first sentence of the trust was, this is a revocable trust. If it's a revocable trust, that means it's in your estate. And if you go over 15 million, if you're single, or 30 million, this happened to be real estate. While it was a truck towing company, it was all the real estate investments that were going over the exemption amounts. And they said it was a revocable trust. And I took one look at it. And I'm like, that doesn't work. That's as if it's in your name at death. It doesn't work for estate planning. It works to avoid probate. Things are in trust and can legally be transferred by a trustee's deed or some other matters, but it doesn't avoid estate tax. So what's the solution there? When a client or person or business, and some of you listening in, when you reach a certain age where you've accumulated wealth, I'm 50, I just turned 50 last year. And when you reach a certain age where you accumulated wealth, yes, a revocable trust may be the way to start because you may not be comfortable with who's making your decisions and how are you going to get paid, how are you going to get the income and what's going to happen. But at some point, we transition people to an irrevocable trust. We're making a gift to the trust and we're using some of this 15 million or $30 million exemption. So if I take my real estate and I put it in a trust and I've got to have it valued and I've got to file a gift tax return because I'm using some of this exemption while I'm alive. Why do I want to do that? Now it's in a trust. Its value is frozen for estate tax purposes. The IRS has 3 years to audit the tax return. And remember that. Do not let your lawyers make a trust for you and forget they won't go the next step and transfer your assets into the trust. They also won't tell you to file a gift tax return. If no gift tax return is ever filed, the IRS can value that anytime they want and your entire planning is out the window. Gift the assets into the trust, file a gift tax return, use up some of your unified credit. That's what we call this because the estate tax exemption also couples up with your annual gift exemption. So you really never know what your unified credit is. What can you give away? What can you gift in your entire lifetime? You'll never know that answer because every year you have an annual gift exclusion, but you have this for your estate. Then, and I don't want to get into timeframes and whatnot, but once the assets are in irrevocable trust, now they're not part of your estate when you die. They've already been counted. You've already used that exemption. Now they're not part of your estate when you pass away. There's no taxation, and they're immediately transferred to the beneficiaries, however the trust is written. What do we do with the Illinois person? Well, I'm a valuation expert. We value companies all over the US, and we'll value some real estate. We valued it, and being a commercial real estate broker and a residential real estate broker now for 23 years, we valued it and we brought it underneath the exemption amount. So the son was freaking out. He didn't know what to do. And I said, look, let's revalue this for an estate tax purpose. I want to value something that I can stand behind, that I can defend in an audit. And sure enough, we got him under 15 million. Another example for you business brokers out there. My neighbor right next to me owns a fastener company. I've always been heavily involved in the fastener industry, nuts and bolts and warehouses that sell that type of material. My father started consulting with them in the 80s, and so we've always been a big part of the fastener industry. So he comes to me, shows me his estate plans, which first of all aren't even signed and aren't signed. And again, how often do you guys find that? And do people find that in your practice? It's pretty often. And this is going to be that exact same example. I've been working with him for 6 months. He handed me his estate tax documents, and what's the very first one on there? A revocable trust. His company is worth $29 million. Just his company. What about everything else? I mean, he had an offer for $29 million. They turned down. They turned down. But that's not the value we used. For estate tax purposes, I will go back 5 years on the estate value, on a business's valuation. I'll look at 5 years of financials. Why am I looking at 5 years? I want to go back and grab those old years because it's going to bring the value down. And the IRS allows that. Their methodology, what they approve, they will allow us to go back 5 years. They won't challenge that. They look at a business's value. So an estate tax valuation is significantly different than what we do as what you all do. I'm not a business broker. I get a lot of business from all of you. What you all do is value that at fair market value. You want to tell them, is it 29 million? Is it 30 million? I'm staring at his boat right now. Is it 31 million? Or from an estate valuation where I maybe came in at 13 million, 14 million. I'm not looking at just the calendar year 2025 and his recasted EBITDA. I'm looking at 5 years worth of data. So estate completes the picture. Don't, this is all value added for you to give service to your clients, whether you're feeding them this information or however you want to incorporate it into your business models. That's what I try to give people when we're educating them. You have the greatest business in the world, but what does it matter if the government takes most of it when you die? They take 40% or more in estate tax. So we don't want that to happen at all. We were even hired once on a publisher, a publishing company called us because one owner had owed taxes to the Internal Revenue Service and then she passed away. There were two owners, and the Internal Revenue Service went after the publishing company. So we were hired to go in there, value it. Sure enough, again, what did I do? I'm looking at 5 years of data. We were able to bring that value down and protect some of the integrity of the publishing company. So, Chris, do I have a question?
Yeah, your examples are absolutely diamonds. And when I hear people actually give real life examples of what they've been doing in their practices, that just it makes my heart chortle. How's that sound?
Yeah. I uh,
So
I practice what I preach. I set up business models for what made me successful and my father successful. And I learn from the examples of my clients. And that's why I learn and I practice what we preach. And that's why those examples are a big part of our presentations in our life.
yeah. So one of the things I'm curious about, because I haven't heard anyone really address this that I trust. How's that sound? And that is, you talked about sole props, partnerships, limited partnerships, corporations, but how about doing business in a trust? Because it seems like every 2 or 4 years or so, you get a raft of emails saying, hey, why are you doing your business in a corporation? You should be doing it in a business trust, like a Wyoming trust or something like that. Can you just talk about that for a moment?
So there's a couple different avenues to kind of take that. So, and you got to be careful. If you're doing business and this is where now you can change back. If you're doing business in a trust or the trust is going to own the company, what type of trust is it going to be? Again, you mentioned another term, Wyoming trust. What does it mean? What are they doing? Is it revocable? Is it irrevocable? Because if it's an irrevocable trust, the tax rate gets to 37% at like $14,000. Ian can put it in your chat or whatever it is. 4,000 to 14. The tax rate goes from 0 to 37% so quickly on income. So when we create an irrevocable trust, and Chris, this is kind of what we're doing because I want the stock of the company owned by the trust. I want to freeze the value of the stock for tax purposes. So now all of the businesses that I make these strategic plans for, that is pretty much usually my recommendation. I want the trust to own the stock. I've made a gift to the trust. Now I got a problem, right? Because any income going, and you know what? I said something a minute ago that he's been sitting on his documents now for about 4 months. He's got his personal attorney that looks at him and says, "Well, this is why he said it." He goes, "You can't have income. You can't have your business." I shouldn't have acted like I was. I shouldn't have just mocked him, but you can't have a business in a trust. Is basically what he's trying to tell him. Your income, you'll be able to take income out of it. That's not true at all. In fact, we don't want the trust to recognize income. So that's why the answer is we want the business in the trust. We want the income to go into the trust and come right out of the trust. And then there's no trust tax. It pays it out to the beneficiaries. The beneficiaries report it on their 1040s as income. What am I protecting? The integrity of the principle of the trust. So if it's revocable, you don't really have that concern because you're probably not filing a tax return for the revocable trust. But if it's an irrevocable trust, you're going to associate it with an FEIN number. It's going to have it. It should file a tax return. I wouldn't not file one. So let me talk about something else. Now you can talk about tax planning. Why? So you see that dynamic, but there's other dynamics. Let's talk about a charitable remainder trust. Why would you want your business into a charitable remainder trust if you're gonna sell the business down the road? There's another avenue is to put the stock of the company into a charitable remainder trust called a CRT. You get a charitable deduction for the gift that you made to the trust. I don't know what the deduction is. There's a mathematical formula behind what your gift is and when you do it and how you do it on how much of a deduction you'll get for that year. Now, the trust owns the business. The trust can then sell the business, and the trust can pay the owners for up to 20 years on an annuity payment, quarterly, monthly, semi-annual, however you want to get paid, up to 20 years. The initial value of the trust, there has to be a 10% remainder interest that goes to the charity of your choice. You can change the charity over the 20 years, and you can be in control of the investment decisions and other things. So that's another reason why we might say, yeah, we want the business owned by a trust. Now, I was just involved in a large deal. We sold an airport for 30, $40 million. I don't want to give too much specifics on it. And in that case, the owners wanted to do what's called a deferred sales trust. Now, some of you may just have cringed like I do when we heard the terms deferred sales trust. Oh, IRS, it's on their dirty dozen list. You got to be careful with them. Use the right people, use the right. I won't do a deal where I'm also doing the deferred sales trust. We use a third party for it. And in this case, we put the owner came to us wanting to do it. I mean, we've got an article out there with the IBBA, as some of you may know, the International Business Brokers Association, where they wanted us to write an article on deferred sales trust. So my father wrote it. We can share it to any of you if you want, and tells you the pitfalls and what to watch for, because these things are attacked. Because what you do is you put now let me step back a second. With a charitable remainder trust, you've got to put that stock into the trust before you sign a definitive purchase agreement. You can have a letter of intent, you can have an indication of interest, but you cannot sign a definitive purchase agreement and then put the stock in. It's too late. The IRS will disallow. But you can do it all the way up to then. You can wait all the way up to then. But with a deferred sales trust, it's pretty much the same thing. And actually, they don't even put it into the trust until essentially the day of closing. And then they put it into what they call a deferred sales trust. That can defer payments to the owner for up to 30 years. The owner can have no control over that trust. That's where the IRS had problems with it years ago, because the brokers, and some of you may do them, California is a hotbed for them, and that's fine. I'm all ears for them. But the old ones, and again, I learned something on every presentation. Some of you may say, no, Roman, that's not right. But what I saw was that those insurance brokers were wanting to sell you an insurance policy on your life at the same time, and they were in control. They were giving owners decision-making capability of the investments within the trust. That's why the IRS didn't like it. The IRS says you cannot have that control as the owner. But we just had one done. They put away about 20 million into these deferred sales trusts. And the deferred sales trust is investing, and we see what their investments are and what they're doing with it. And then they can be paid out for up to 30 years. And there is no 10% charitable gift inside this trust. You avoid that if you don't want to donate to a charity. So long answer, Chris, but yes. Generally speaking, I want the business owned by a trust. I mean, I really do. So hopefully that answers and that's why you've got this estate tax protection, and you've frozen the value of the company. Now the company can grow as much as it wants, but the stock's already in the trust and you've already exempted it out. Now it just goes to the beneficiaries. There's one downside. Um, One downside would be if we, and with the small estate, I'll do this. If you're under the exemption already and you're going to give the company or the real estate to somebody at death, you're not going to sell it, you're not going to get paid for it. Got to remember the difference. If you do it in a will, you just give it away in a will, what does the beneficiary get upon death? They get your stepped up basis. They get fair market value to whatever that asset is. So if you had it in your estate at $100,000 and at death it's worth $1 million, and now your heirs want to sell it, they can sell it for $1 million, and they just got a stepped up basis tax free. But if you put it in a trust, they inherit whatever your basis is. So they decide to sell it down the road. They're going to have capital gain tax to pay. They're not going to have estate tax. But in a trust, in an irrevocable trust, they don't inherit your basis. So keep that in mind. I just had a client that we were doing some work for his mother. I had to give a speech on a Super Bowl Sunday one year. I didn't think
Okay.
anybody was going to come to this Orlando speech. There was a DJ in the audience. This was like 4 years ago. There's a DJ in the audience. And he called me this year. He goes, Roman, and it was for a big rental conference. He called me this year and he goes, Roman, after your tax speech, I got into business and I bought a rental company and I'm buying a jet this year. I need to get rid of some profits of, because I got profits of about $20 million. I need to get rid of some profits of $5 million and go buy a jet. Sometimes it's these tax things that get us there, that push us over that edge to get us where we want to be. So just keep that in mind. And that's how all of that gets created. Chris, hopefully that answered your questions.
So kind of. The real question was doing business as a trust, like you do business as a corporation. And so there's a little bit of difference from what you were saying, I think.
Well, I would not recommend it because the tax rate. And again, what's the trust going to be structured at? Now, what are you going to do with the business? If the business is operating as a trust, does the business have profit? And look at the trust tax rates and what's it doing? Again, it kind of relates to what's it doing. Is it distributing its profit? How's it doing it? But if it's the business, ABC Trust is who you're going to. Whew, I'd be really careful with that because of the tax rate. And then does a trust have the same? You got to look at state laws. What kind of liability protection does a trust have? Are there spendthrift provisions in the trust that can be breached? Are you really and maybe some people will say, well, it's easier to operate a trust than a company because I can follow trust formalities better than I can follow corporate formalities. So I can't pierce the veil of a trust as easily as a corporation because the trust is hard. There's just not that as many formalities. And I don't, I wouldn't necessarily go with that. I mean, if somebody wants to really protect their company, as we've learned and learned and learned, I mean, file a Delaware corporation and file it formally in the state you're operating in. Delaware is the most protective state in the country to protect corporations. So trust ownership of a company or running the business as a trust. I personally I don't recommend it, but again, I want to see the structure. Someone says, "Oh, I'm going to do it. Here's the structure. Here's what it's going to look like." Fine. Let me vet that. Let me see where my pros and cons are to that. I wouldn't just wipe it off the table, but it wouldn't be in my strategic plans right now. I can tell you that.
Okay, good. And then Sharon is asking in our chat about land trust and how do they fit into estate taxes?
Yeah, land trusts can fit into estate taxes pretty well because a land trust it kind of depends on you're in California, but it kind of depends on some of the local rules sometimes, but a land trust can designate a beneficiary pretty easily. And a land trust is really, we form a simple trust. You put it in the name of a land trust, you file the deed in the name of the land trust, and it's really just a trust over real estate. Again, there's, it's not as much different as any other type of trust. The property's put into a trust, you call it a land trust, you file it at your county level with the deed, and the trust document dictates everything else. So it to me, I don't even use that terminology when I'm filing a trust and putting real estate in it. I break it down into simple terms of is it revocable? Is it irrevocable? Typically, a land trust is an irrevocable trust. You can't change it, but it can be either way, I believe. And when I said you can change trusts, it's called decanting. You have a decanting statute where if you don't like the way the trust is running as an irrevocable trust, you go through a process called decanting, or you simply just distribute the assets back to the owner and the trust is gone. So even though it's an irrevocable trust, it doesn't mean it can't be changed forever. There are ways around it.
Okay. All right. So thank you for the tangent. And you've got so much great stuff coming up in your presentation. I don't want to defer any longer here.
Yeah, and I'll get through it. I know I'm going to run a little long. I'll try to go quicker. The
And
one,
it's okay because,
okay.
people can watch the recording.
I always go, I always skip them. Bonus depreciation. So the Big Beautiful Act delivered substantial wins for us again. And this is why, again, I got the call from my client, extending bonus depreciation at 100% for property acquired and placed in service on or after January 19th, 2025. That means you qualify for immediate deduction of the full cost of equipment, machinery, and business assets rather than depreciating over several years. And the one client I spoke of is not the only client who has called about buying a plane. So all of a sudden that, and we talked at the very beginning, how is this going to impact the industry? Look at this. Look what it did already. People are spending, businesses are spending money. They're investing in assets. I'm looking out my window now and I can see one of the assets that my business bought. And I get calls about this, especially I've had calls from California clients. Roman, what can I buy? What car can I buy? And I'll digress a minute here. What car can I buy and expense the whole thing? Well, then you know what? I've been married to my wife for 27 and a half years. I love it. She'll be at my live presentations and sometimes she's in the back of the room and she learned too much. She learned way too much when she was listening to me. We're out to buy a vehicle and we're looking at one of the four-door smaller SUVs. And she looks at me and she looks at the salesman. She goes, but we can't depreciate that one right away because it's under 6,000 pounds. But if I get the fully loaded full-size SUV, you can depreciate that one, Roman, right away. And you said you needed more depreciation. She's learned too much listening to me. So I'm looking at a full size, fully loaded Cadillac Escalade in my driveway right now. So, but we got all these things back. So yes, it helped. Yes, we were able to depreciate it. Yes, it's a work vehicle. So you gotta qualify all those matters. But we got it back in here. Bonus depreciation, section 179. Those things are still all there with us. R&E expenditures. The new bill made permanent the domestic research or experimental expenditures paid or incurred in tax years beginning after December 31st, 2024. They become immediately deductible. Previously, businesses had to spread these deductions over 5 years. A lot of businesses don't realize that they have this deduction out there, this domestic R&E. I represented an aerospace engineering company here in Florida, and they had never deducted R&E. And we looked at their tax returns and we went back, I think we went back 3 years and we amended their tax returns and refiled because when they're building these parts for aerospace, they're doing all this research and design while they're forming the part, while they're putting it into the forms. So we were able to get them some significant deductions. Now this was years ago, and they had to deduct them over a couple of years, but now they can be immediately deductible under our new law. Section 179, I just kind of mentioned it, but you could expensing the amount of a 179 expense deduction increases to 2.5 million for years beginning after 12/31/2024, and the phase out begins when the property costs exceed 4 million. And then as the property costs go up, you could phase out of that deduction. So you want to be within that range, so to say that what you can expense up to the $2.5 million. This enhancement provides additional flexibility for businesses to immediately expense equipment purchases that don't qualify for bonus depreciation. Chris, got a question?
Yeah, the research expense. A lot of people think it's research like you said, aerospace or something like that. But how about a real estate broker and they're doing some research on how to do marketing or reach new markets or building a new type of a building or something? Are those R&E deductions available to your typical business that's not science or manufacturing?
That's a good question. I'll have Ian respond to that. I've never had that question before, and what a good question and a pointed question to this group. So I'd like to know the answer as well. Yeah, are there qualified industries? And Ian he's texting me a little bit back and forth, so he'll be on top of that answer for you. We'll
And
get
Ian's been doing a good job too of keeping up in the chat.
say what? I'm
Ian's
sorry.
been responding in the chat too.
They're awesome. My guys are awesome. And Ian, Lacey, Letitia, all my accounting team, they're awesome. And they know this stuff. I told my college roommate called me the other day and he goes, Roman, I want you to file my tax return. I'm like, I haven't filed a tax return. Probably there's one tax return I file every year and it's mine. everybody else that works for me usually even has input on my tax return. So I really focus on my M&A work, but that's why those guys are awesome. They know their stuff. I always tell people, somebody asked me one day, they're like, Roman, if I hire you, am I going to work with you? I said, yeah. But if you're working with one of my team members, it's because they know it better than me. I will never say that I know everything or try to act like that at all. I will have my team members involved when they know things better than me. And Ian is a prime example. Ian put this entire presentation together. Ian is the one that does all of that in the background for us. So I very much thank him. And he's getting ready to take his CPA exam. So that's going to be awesome. All right, I digress. The QPP depreciation, a new provision, allows 100% first year depreciation for qualified production property used in manufacturing. So here's your definition there. If the business involves manufacturing, agriculture, chemical, certain other operations, this can provide immediately tax benefits for facility investments and production equipment. Of course, California, this is going to be huge for all the industry that they have. And, there's very, very vast industries that you have out there. I drove through uh, oh gosh, I'm gonna the pistachio fields one day on my way to I was working out in one of the winery countries, Paso Robles, and I drove through all that area. What a phenomenal agricultural area that you drive through just to get out to Paso Robles. And I probably said that wrong, and I apologize, 'cause I always would say it wrong to my client. Enhancement of certain credits. So the OBBA increases the Section 48D advanced manufacturing investment credit rate from 25% to 35% for qualified property placed in service after 2025, increases the maximum credit to 40% of qualified child care expenses, and it includes a new provision for small businesses allowing a credit of 50% of qualified child care expenses up to 600,000. A couple more notes about that. An eligible small, of course, we're talking about child care, and of course, that's all in the news right now, all right? So an eligible small business is one that meets the gross receipts test of less than or equal to $25 million, and it's adjusted for inflation. So it has to be a small business. And that's a lower limitation than we see on a lot of things. When I see things about qualified small business, and I use that terminology, how do you know? That's how you know. You got to get into the code section. Usually on page 1 of the tax return, if you're a C corporation, you're a qualified small business, if you have less than 50 million in assets, and now they just increased that, they always give us a numerical definition for what we call the business or the small business. And that's it there. It has to be gross receipts of less than 25 million. In 2025, the small business gross receipts threshold is 31 million, and it's effective for amounts paid or incurred after December 31st, 2025. 1031s. Boy, what can I say about 1031s? We still have them, thank goodness, right? The 2017 Tax Cuts and Jobs Act took away all of our 1031 ability for anything else, right? Equipment, other assets, whatever it may be, but not real estate. You guys are professionals. All of you listening are professionals, hopefully, or you want to be. And the one thing I can tell you, the one good piece of advice I give you on 1031 is tell your clients, tell yourselves, call an advisor if the client is going to sell a piece of real estate and you think there might be a 1031 opportunity for them. What is a 1031? Let's just break down. You sell a piece of investment property. You can't do this with your residence. You sell a piece of investment property. You then we call this the relinquished property. You then buy a replacement property within 6 months. Then you've deferred you should be able to defer all of the gain on the sale, but not always. Make sure your clients are meeting with their tax advisors or somebody to find out, is all of the gain eligible for deferral? That's not always the case. So be careful there. Now, what's part of that? You can't just do it on your own. First of all, you cannot take possession of the money at closing. That's one of the one things I can't reverse. And what's supposed to happen? You enter into a contract to sell your property. That contract is supposed to be assigned to a qualified intermediary, not you. And maybe if you're the broker, you can act as the qualified intermediary, but you got to be careful. There's provisions that if I'm already acting as an attorney for a client, I am not allowed to be their qualified intermediary. So it has to be a new client to me or one that I haven't worked with in a long time. They assign the contract to me. I sell the property on behalf of them. They'll sign the deed, but all the closing work will say Roman Basi, managing partner, president of this company, as qualified 1031 agent for, and then the name of the company. Within 45 days, they have to give me a letter identifying what their replacement property is that they're going to be, or options. And there's different rules on that letter. Don't worry about it. But within 45 days, they've got to give me a letter. And then within 6 months from the original closing date, they sign a contract to buy the replacement property. They assign the contract to me because I'm holding the funds and I buy the property for them and the deed goes in their name. Also, you can do a reverse 1031. What's a reverse? You can buy the property first and then you have 6 months to sell a property. That one gets really complicated. You have to have what's called a qualified exchange accommodation title holder, a QEAT. That's a separate company that we formed. We buy the property in the QEAT. I just did this. I bought a 22-unit apartment complex, put it in a QEAT. We held it in the QEAT while we were waiting to sell a condominium in Florida. And then we deferred the gain from the sale of the condominium. It's called a reverse 1031. The bottom line is, if someone calls me and says, Roman, I just sold my property and I heard I got to do a 1031, it's too late. It's too late. I can't change where the funds went. I can change closing documents if the title companies that are involved are willing to, or if there wasn't a title company involved, no big deal. I can change a lot of things. I can't change the flow of your funds. And that happens so often. So it should be this, we should have this in red with, Ian, next time we did give this program, we got to have it in red with exclamation points. Call an advisor first. Call an intermediary. You need someone to help you. Okay. Opportunity zones. I think I didn't mention these, but yeah, I did because I did with my friend with his capital gain with his stock options. It's now another permanent part of the tax code because the current one ended on December 31st, 2026, but now we got a new law. So starting July 1st, 2026, with designations taking effect of the zones on January 1, 2027. Again, what's the real benefit here? What you need to know is you can invest capital gain into an opportunity zone fund. Or get this, you can create your own opportunity zone. There's these zones all over the country. They're going to redesignate them. They're everywhere. They're in every zip code now. And you can buy property in the zone with your capital gain. You can then invest in that zone. There's rules on the investments, but there's a substantial improvement rule. So you got to watch out for that, that you have to improve the property to a certain level within a certain amount of time. But you can buy the property, invest in the property, and you can have your own opportunity zone or not, you can have your own opportunity zone fund. I sold a client's landscaping business for $25 million, and he created his own, we created it for him, an opportunity zone fund. He bought the property, started investing in real estate, building houses in the property. And now as long as if you hold it in there, like we said, for 10 years or more, any new gain is going to be tax free. So these are huge opportunities. We're glad they got renewed in the law because we were afraid of this. Okay, there is a slide on qualified small. I do read the slides before I go into it, but then I forget where they all are. Qualified small business stock. Here's the diagram. Here's what you need to know. Look in yellow. Ian highlighted it there in yellow. What you really need to know here is you have to have what we call the initial issuance of C corporation stock. And it has to be in a certain, look at how the law has changed. 1993 to 2009. 2009 to 10, it changes a lot. Again, Congress changes these things. And look at the exclusion percentages where we're at now. Now they gave us a 3-year benefit. We can exclude 50% of the gain. Now, let me tell you a story. I promise I won't go too super long. My wife's probably ready to go to dinner here. My best friend calls. His dad had a moving company in Missouri that he had started many, many, many years ago. In fact, I saw a picture where it was like a horse and trailer from his grandfather's and stuff. So this was an old moving company. He says, Roman, my dad's gonna sell me the company. I said, okay, let me look at the stock record books. Or what kind of company are you? He goes, well, we're a C Corp. I was like, well, hold on, Leo. I think you qualify for QSBS. I looked at the incorporation document for the company. Now look where that law started, August 11th of 1993. The company was incorporated in 1992. Now, the law says you got to fall within these timeframes for original issuance of stock. Doesn't say incorporation date. So I looked at the corporate record book, which was this old record book stuffed with all kinds of things, and I looked at there's nothing in there for the early 90s. I'm like, Rafi, what'd you do in the 90s? He's like, I don't know, Ron. We didn't even file tax returns for a couple of years. I took over the company and we incorporated it in 1992. the very first incorporation of the business, but it had been in business a long time. And we didn't file tax returns for a while. We weren't making any money at that time. So I then asked him, I said, because his tax return, he had no tax returns. He had no K-1s. He had nothing for the company back then. And I said, would anybody else have known what the legal ownership was at that time? He goes, no. He goes, we don't have stock records till the late 90s. So what did I do? Go into the corporate record book, issue him the stock in September of 93, and we reported the sale under QSBS because the underlying rule here is just because a company is incorporated doesn't mean that the person that's holding the stock got the stock on that day. Original issuance of stock. And when did they get it? They get it in 93. Did they issue stock in 2005, 2010? You can't buy stock from someone and count it. You can be gifted it. You can receive it in an estate, and then you tack to their period. So it's tricky. It just, again, now you've heard it, you've seen it. It's a great tool, and we work with this a lot. QSBS increases the lifetime exclusion from QSBS gains from a single issuer and raises the gross asset limitation. Like I talked about, look at the first box. It used to be you had to have a company had to have assets of less than 50 million. And now it's increased. You can have them of less than 75 million. The gain can now be 15 million per shareholder. And then we have the change to holding periods. I'm telling you, it is a fantastic tool with companies. We have done so much conversion to C Corps over the last couple of years, and we use them and we do it and they're good. Chris, what's Chris?
I just want to emphasize that if you are not familiar with this, you need to go back and rewatch this and do some research. So it was at the IBBA conference in Denver when I heard you and your dad talking about this that I became aware of it for the first time. And I was a tax practitioner for 12 years in the 80s and 90s, and I had no clue. And so this is probably one of the biggest overlooked benefits that small business owners, especially, people who have an opportunity to choose whether they're doing an S corp or a C corp, that they just have no clue what the opportunity is here.
And your buyers are going to push back on a stock deal and say, and I know we also have limitations of what a broker can advertise and do in a stock deal. We know we have the limitations, and God rest his soul, Mike Ertl with IBBA, who helped champion the bill through the broker security bill or whatever. Mike was a very, very good friend of my family's, and I live here in Clearwater Beach, real near to where he had his summer place here. Um, it is such a tool, and buyers are going to come in and say, well, I don't want to buy stock. I'm not going to take on that liability. I mean, the answer around that is look at this benefit that the seller can get. They can reduce the price. They can bring it down a little bit because they're going to save on taxes and issue a significantly good indemnification. That's where you can change the tide and say, well, they're not going to buy stock. They want to buy assets. Well, look at the savings the seller can have. We're going to indemnify you all the way for unknown liabilities. We can do that. We can paper it right. And I know people are going to say, Roman, there's always a hole in something when a lawyer papers it like that. But that's how I get it through. The reduction in price to a buyer, share some of the tax savings. We get it done. That's how we get them through. So.
Well, and the other thing that I think commercial real estate brokers need to understand is they need to understand how this works because you can maybe talk to someone who's had a business for a long time and they're like, yeah, but I can't sell my real estate because I've got this business. I can't afford to get rid of my business. And by coupling this concept with a business broker and a good tax attorney, you've now got a commercial real estate transaction.
Yeah, excellent. Excellently said. Exactly. I need to send you to one of my clients that in Texas who's having problems. Love it. I love it. Ian's probably cringing because he knows who I'm talking about. We're getting close to the end, guys. Reporting requirements repeals the revision to de minimis rules for third-party network transactions that were enacted as part of the 2021 American Rescue Plan, and it's raised the reporting level for 1099s from 600 to 2,000. Boy, aren't we happy with that? I know there's a lot of individuals that don't want to report those 1099s, and be careful, everybody. So many contractors love to use all these pay methods and they think that the IRS isn't tracking them, Venmos and Zelle and PayPal. And I'm going to tell you, our team is in the trenches on audits. We handle IRS audits, and they get that document. They get the Venmo transactions. They get the Zelle transactions. It's not avoiding taxation. It's not. They have the right to subpoena those records, and they do. I should tell you, I am a IRS instructor. I teach the annual. My father, myself, Lacey Henson, Ian is a big part of it. We are one of the providers to the IRS that, and don't want to scare you, but we're one of the providers of the IRS. We give 18 hours of education every year to tax return professionals, the people that are out there doing tax returns. And then if the people take our course and they pass the exam, they are then listed on the Internal Revenue Service's website as a provider. If they don't do that, they're not listed on the website. So, when we see all this, we're trying, again, practicing what we preach. We're trying to tell you what works. This is how we're teaching our tax return practitioners as well. So we're using the tools the IRS is letting us use, these type of things. Okay. Real estate investment trust, a company that owns, operates, or finances income producing real estate. It's designed to let investors buy shares and gain exposure to real estate without directly owning property. This is becoming a little bit bigger. You're seeing I'm not going to think of the name of it, but there's a new company VRBO and Airbnb, and then there's a new company, and it was a success of one of those, and they're selling off, these shares. I mean, it's not like a timeshare, but they're selling off these shares of real estate. So people are able to be real estate investors, but not necessarily directly own property. Honestly, I don't deal with a lot of them. I haven't seen a REIT in a long time in my office. Again, probably because I'm lower middle market where my main structure is. And I mean, when my owners sell their businesses, 99% of the time they know where their money's going. But here's some points on it. REITs must distribute at least 90% of their taxable income to shareholders as dividends. They do not pay federal income tax at the corporate level. So it's a flow through. The shareholders pay taxes on the dividends they receive. Oh, I'm so glad I got to this slide. So every deal. Um, we talk a lot about tax minimization and deferral exclusion and all this stuff, and our owners' heads are swimming, right? There's just so much information, and it's not what they do. I'm dealing with an electrical conductor owner, and he designs and builds electrical conductors, and he's like, Roman, I don't understand your tax language. This is how I help them. Now, we didn't include an example of it, but we call it our tax minimization analysis. And if your clients are selling a business or even real estate and they're not getting this done by their CPAs, or they're just getting a blank. How many times does a client call you and say, well, I can't sell my business because my CPA said I'm going to pay 40% in tax. So I'm not selling. I'm just going to keep running it until I die. We get that. Or they'll say to you, I'm only going to make the money I would make if I stayed working here for 3 years, right? So I know a lot of you are probably like, oh, I get it all the time. Why would I sell my company? I can keep working and make that in 3 years. They don't understand the cash flow of the deal. So a TMA, tax minimization analysis, it's a waterfall. I love that Ian, you put that in there because he knows I use that term. It's a waterfall. I think he knows all my language of your entire transaction from start to finish. So here's what we do, and I don't care. Someone comes to me and they say, I'm worth this or I'm worth that, but I want to sell my company. I don't care what your company's worth. We want to know what you're going to end up with when the deal is over. What's going to be in your wallet when this is all said and done? So here's what we do. We do this entire analysis. We start with the deal price. What is the deal price? Then we're looking at adjustments to that price, closing expenses, broker fees, attorney fees, accountant fees, working capital calculations, right? Working capital adjustments. For those of you that don't know what a working capital adjustment is, a buyer will typically say, I want the working capital in the business when it closes. And working capital is current assets minus current liabilities. And they want an average of that at closing from 12 months or whatever they pick. If the average is above it, you get more money and it affects your purchase price. If it's below it, you get less money and it affects your purchase price. So now we have a new net selling price. So then I can say, okay, how do I want to structure the deal for tax purposes? So I can show my owners we're selling these assets. This is going to be your taxation, hopefully none. We're selling goodwill. That's where we're going to try to put the tax. Or what are we doing? Are we doing a stock deal? Are we doing an asset deal? Oh, hell, are we doing a 338H10 or a 336E? If you haven't heard those terms before, that's a hybrid transaction. We sell assets. We sell stock for legal purposes, but we sell assets for tax purposes. I put these structures in there. Now I can calculate my tax amount. I can show my owner my taxes. I'm not done. Then I want to look at what liabilities have to be paid off. This is where owners don't understand it. They're like, why am I deducting my liabilities now when you've already paid the tax on a larger amount? Because liabilities paid at closing are not a deduction from the proceeds. So now I've got these net after cash proceeds, and I'm going to show the liabilities being paid off. I'm still not done. What if there's a non-compete? A non-compete is ordinary income tax. It's not capital gain to the owner. So I'm going to lower that allocation as much as I can and save them taxes. Is there a lease? Is there a consulting agreement? Is there an employment agreement? That's page one. Now I'm not done, but I'm done. I can show them here's what's in your pocket when you close. Now, what do you want to do with that money? Now I can look at investments, trusts, qualified opportunity zones, whatever else I might want to look at as an investment. Folks, this has been my biggest tool in the last 10, 15 years. I do one on every deal, and the owners know I know what I'm going to make if I sell my company today. They can update it every month. A new balance sheet is all someone should need, and it can be updated every month if they want to. A lot of times they don't need it. They know right where they're kind of going to be. Or we can update it as the deal changes or as the deal flows. So just keep it in mind. It can not only pay for itself through the tax savings, we also can discover other ways to do it. And it's a we did one once. And one of our clients says he was a janitorial supply company in California that I was selling years ago, one of my first deals, and we sold it for $9 million, and two owners owned it. And we did this tax analysis, and then the silent owner calls us and he goes, I don't need any of that. I got huge capital gain losses. I'm going to apply them here. When we're doing a TMA, we're going to ask for the owner's personal returns. We want to know what's happening personally, because that's the first deal we kind of figured. We were like, oh man, we got to deal with their personal returns so we can apply those types of losses and things. And I know you're in California, but no matter what state you're working in, we're looking at the different state taxation laws too and how we can get around them. Terminated energy credits, and you can just have this slide for yourself. These are the energy credits that have been terminated through the new bill law. So I hope it wasn't too much. I hope you took away a few good nuggets from today. Again, if you got any questions or inquiries, there's all my contact information. You can email me. Ian will probably be the one answering you right away. Thank you all very much for listening in. If, of course, if I can be of any assistance in your deal, our website is taxplanning.com. Shoot us an email. The way, just if you want to know the way that I work, there are two things. If you want to be on our advisory list, we have a once a month tax advisory. Ian writes it. It's a small business tip. You can share it to your clients. It's free. Please shoot me an email and say, I want to be on your advisory list. Dano in our office will put you on our advisory list. If you ever want to work with us, all you got to do is shoot us an email and say, hey, I would like to, I have a client that needs to talk to Roman, or we'd like to work with you. I will be on those calls. I will. And typically we're the next day. We'll have a call the next day if the client's available. And then immediately after the call, we send out an email from one from our law firm, one from our accounting firm. We tell you how we're going to work, what we're going to work, and I try to flat fee almost everything we do, or we'll give you a range of where we think the fees are going to be. So again, I'm not here to sell these services today. I hope I educated you. I hope you learned something, and I really appreciate the association for having me today. And hopefully someday we'll be in person.
So, do you mind if I ask you a quick question?
Sure.
But maybe it's not a quick question, but because I want to give you as much time as you would like to answer it. So, we've talked about a lot of stuff today, and since we're the Commercial Realtors Association, we're not the Business Brokers Association. Can you just focus in for a minute or two on what are the most important things that a commercial broker, a commercial realtor should know about the tax law and for their own taxes and for also their clients' taxes? What are like 3 points or something that the commercial broker should look at?
Let's start with the basic of legal structure. What entity is holding the property? Is it proper? Is it in an LLC? We like to have real estate in LLCs, and we like to have them in series LLCs. I could go on forever about that. That's a discussion for another day. My company is a series LLC. If you're operating like that, or your clients are,
And California is not good with series LLCs. So
filing fees are expensive and things of that nature. But then that's why it depends on what they're doing and where they're explaining. That's why we want to know what's the structure. I'll walk into a business and the real estate is owned within the company. And I'm like, no, that's not what we want to see. So that's probably the first one. Cost segregation to me is going to be and that's the biggest hot ticket item right now. Are you cost segregating the real property, the personal property? And I will try to do that upon acquisition. I don't do it after acquisition. I want to cost segregate in my contracts. Possibly I'm lowering real estate taxes. Possibly I'm getting 179 or bonus depreciation expenses. So that's a real bit to me. Those are the two big ticket items that we get. The third one would be back. I mean, I would kind of say estate planning. What's the back end of that for the ownership? So you've got these different issues. I mean, if you get into the contract issues and the brokering parts of the issues, but these are the issues for the owners that you're dealing with. And for you, you look at. I mean, I always check the company first. As soon as somebody comes to me and says, "I got this company or I've got this real estate," you know what? About 7 or 8 times out of 10, that's not how it is. It's not even owned. We're working with this electrical conductor company, and the person kept telling us they owned 100% of the company, but they've got K1s for the last 3 years with another 10% owner on the K1. The K1 is going to dictate the ownership. So it's just those basic things sometimes, and that starts to snowball with other things. So that'd be my answer.
Yeah. And I find as a commercial realtor, my background as a certified financial planner, an estate planner, a tax practitioner, an executive in the Silicon Valley, and other things that I've done in life, that adds a lot of value to the transaction when I bring those other disciplines in and I bring that expertise and wisdom from, well, 64 years of life, you know. And so those are great things that you brought up. I really appreciate you coming today, joining us. And I know that I'm going to be putting out a blast to the friends of the RCAOC and saying, hey, if you weren't on the live stream, this is one that you've got to watch because it's full of nuggets.
We appreciate it. We really appreciate it. We really do. We all of our business is basically referral based. So it's been a great career working with brokers across the country, whatever field you're in. So I appreciate it, Chris. Thank you very much. Happy New Year to everybody. And we look forward to hopefully helping some of you someday.
Thank you very much, Roman. Happy New Year. And to Ian in the background for answering questions and looking forward to the answers to the questions that you didn't have immediate responses to. All right, there we go. Thanks, guys. Take care.